Would you like a good deal on a great stock? Like the idea of collecting safe, growing dividend income that beats the market? Want to know about a high-quality dividend growth stock that's down nearly 30% from its recent high? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing critical biopharmaceutical products to millions of people. Many of the things that we tend to buy every single day are rather discretionary in nature, but medicine, generally not one of those things. By helping to treat chronic diseases, this company is providing necessary products to very willing buyers. And they're making more and more money by doing so, which they share with their shareholders in the form of growing dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of AMGN Inc., which appear to be trading at a significant discount today. AMGN Inc., stock ticker AMGN, is a global biotechnology company that develops and manufactures a range of human therapeutics. Founded in 1980, AMGN is now a $113 billion by market cap healthcare behemoth that employs more than 24,000 people. AMGN offers treatments for a range of ailments including anemia, rheumatoid arthritis, psoriasis, cancer, and osteoporosis. Fiscal year 2020 total product sales break down geographically as follows: US 74%, rest of world 26%. Some of its major drugs include Enbrel, 21% of fiscal year 2020 sales, Prolia, 11%, Neulasta, 9%, Otezla, 9%, and XGEVA, 8%. Their biggest blockbuster, Enbrel, generates over $5 billion in total annual sales and has patent protection until almost the end of the decade. AMGN is benefiting from a rising tide that is lifting all boats. The rising tide is demographics. Our global population is growing larger, older, and richer. There are simply more humans. Simultaneously, on average, these humans are living longer than ever. In addition, they're wealthier than they've ever been before. There's essentially a straight line from the demographics to increased drug sales. What's particularly exciting about AMGN in this situation of a rising tide is that they're not just any boat, they're a world-class boat, as evidenced by their fundamentals. This bodes very well for their ability to grow their profit and dividend for many years to come. Already, AMGN has increased its dividend for 11 consecutive years. The 5-year dividend growth rate is an astounding 15.2%. That double-digit dividend growth is paired with a starting yield of 3.5%. This yield is substantially higher than what the broader market offers. It's also 80 basis points higher than the stock's own 5-year average yield. This is a highly appealing combination of yield and growth that I don't often come across. And with a payout ratio of only 41.9% based on midpoint adjusted earnings per share guidance for this fiscal year, the dividend is in a great position to continue growing at a relatively high rate. I love dividend growth stocks in what I refer to as the sweet spot. That's a yield of between 2.5% and 3.5% paired with a high single digit or better dividend growth rate. As you can see, this stock is basically as sweet as it gets. Looking at business growth, AMGN increased its revenue from $15.6 billion in fiscal year 2011 to $25.4 billion in fiscal year 2020. That's a compound annual growth rate of 5.6%. I like to see a mid-single-digit top-line growth rate from a mature business such as this one, and AMGN more than delivered on this. Meantime, earnings per share expanded from $4.04 to $12.31 over this time frame, which is a compound annual growth rate of 13.2%. Truly impressive impressive. It's obvious that Amgen has been able to fund double-digit dividend growth because it's been producing double-digit earnings per share growth. There's a lot of excess bottom line growth here, aided by meaningful share repurchases. The outstanding share count is down by 35% over the last 10 years. Looking forward, CFRA is forecasting a 9% compound annual growth rate for AMGEN'S earnings per share over the next 3 years. This would represent a slowdown in bottom line growth compared to what Amgen has enjoyed over the last decade. However, if this is what comes to pass, it would still be a very strong result. I doubt many shareholders would be terribly unhappy with this. On one hand, CFRA notes that Amgen features a wide pipeline, a promising biosimilars business, a diverse product portfolio, and robust cash flow. That robust cash flow has historically been used to support internal growth, acquisitions, buybacks, and increasing dividends to shareholders. Regarding acquisitions, Amgen notably acquired the worldwide rights to inflammatory disease drug Otezla for $13.4 billion in November 2019. CFRA expects this drug to surpass $4 billion in annual sales before the expiration of certain patents in 2028. However, Amgen has a considerable headwind to overcome in the form of slowing growth across key legacy drugs, especially Enbrel. Fiscal year 2020 revealed a 4% year-over-year sales decline for Enbrel. I see CFRA's near-term earnings per share growth expectation as reasonable, and this would allow for Amgen to grow its dividend at a corresponding rate. In fact, the low payout ratio gives them the flexibility to hand out rather generous dividend increases for the foreseeable future. Moving over to the balance sheet, Amgen commands a good financial position. The long-term debt-to-equity ratio is 3.5. While that is very high, it's only so high because of low common equity, not an outrageous debt load. The interest coverage ratio of over 7 shows no problems with servicing debt. Profitability is extremely robust. Over the last 5 years, the firm has averaged annual net margin of 27% and annual return on equity of 46.3%. There's almost nothing to dislike about Amgen. With a rising tide that's lifting all boats, Amgen is one of the best boats to be in. And the company does have durable competitive advantages, including patents, R&D, IP, established relationships, entrenched products, and global scale. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. I see both litigation and regulation as elevated risks for this specific business model. Some of Amgen's smaller drugs, including Neulasta and Epigen, are now looking at biosimilar competition. Any major changes to the US healthcare system, especially around drug pricing, would impact Amgen. Amgen's Otezla acquisition was costly. This acquisition only makes sense if the drug sells very well. And the company's balance sheet, while still good, has weakened in recent years. These risks should be carefully considered, but I think Amgen's appeal as a long-term investment easily outweighs the risks. With the stock down nearly 30% from its 52-week high, the attractive valuation only serves to boost its appeal. The price-to-earnings ratio is 20.7. That's better than the broader market's earnings multiple. It's also materially lower than the stock's own 5-year average price-earnings ratio of 24.6. We can also see a disconnect on the sales multiple. The current price-to-sales ratio is 4.5, and that's well off of its own 5-year average of 5.6. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. This is on the higher end of what I usually allow for, but not the highest. However, I believe Amgen's quality and growth profile warrants it. This is about half of Amgen's demonstrated long-term dividend growth. It's also much lower than the 10-year earnings per share growth rate, and there's a lot of daylight between this number and what CFRA is expecting from Amgen's earnings per share growth over the next 3 years. With a low payout ratio giving them additional flexibility on the dividend, I actually see this as rather conservative. It wouldn't take much for Amgen to far exceed this dividend growth rate over the coming years, but I always like to err on the side of caution. The dividend discount model analysis gives me a fair value of $302.72. The reason I use a dividend discount model analysis is because the business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Amgen as a 3-star stock with a fair value estimate of $200. CFRA rates Amgen as a 4-star buy with a 12-month target price of $245. I came in surprisingly high, but I'd also argue that Morningstar is too low. Averaging the 3 numbers out gives us a final valuation of $249.24, which would indicate the stock is possibly 24% undervalued. Here's the bottom line, guys. AMGEN Inc. is a high-quality company across the board. They benefit from a rising tide lifting all boats, with a market-beating 3.5% yield, double-digit long-term dividend growth, more than 10 consecutive years of dividend increases, a low payout ratio, and the potential that shares are 24% undervalued. This is a world-class healthcare business that is on sale. And now for a special news announcement. Canada's government has officially excluded Boeing's Super Hornet from the bidding for a potential $19 billion Canadian contract to build 88 new fighter jets. This leaves Lockheed Martin Corporation, stock ticker LMT, and their F-35 stealth fighter as a near lock to get the contract. This would be another huge win for Lockheed Martin, which remains one of my very top ideas for long-term dividend growth investors right now. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.